Well, hello, welcome. It's the last trading week of October right here in Lagos, Nigeria. Happy Monday. Well, let's get to the top stories that set your agenda. With a lot of drama playing out in the global oil market, oil prices slid more than 4% today as Israel strikes on Iran over the weekend. We're dubbed as limited, by local media, but we see city analysts discounting chances of an escalation that disrupts oil supply. So that's what investors are concerned about. What's going to happen with supplies, what's happening with demand, and we see that impacting on the prices there. Brent almost losing that $70 range, down 4.34%, $72.75 a barrel, while the U.S. grade WTI crude, that lost that $70 level, $68.52 a barrel, down about 4.54%. We see, Israel on Saturday attacked Iran's military installations in 3 provinces in response to Tehran launching ballistic missiles at Israel. That was for October 1st. From news agencies they reported the attack, which killed 4 soldiers, had inflicted limited damages. The strike steered clear of oil and nuclear and civilian infrastructure locations. We see local news network said that Iran's oil industry operation is underway, normally with no disruptions. But we see, investors always overreact. For weeks now, markets had braced themselves for an Israeli retaliation as Middle East tensions have continued to rise following an attack on Israel by Iran-backed Hamas on October 7 last year. All markets' key consideration had been a direct engagement between both parties, with concern of an attack on Iranian oil facilities, rising, in recent weeks. But we're seeing a big drop there, 4.34% to start the week. We'll be monitoring these prices, but it's already starting off weak. Might be a weekly drop there for the oil markets come Friday when we analyze everything that's played out in the market. Let's get a check on the FX market. We see the NAFEX appreciated by about 18 naira 53 kobo to fix at 1,638 naira. 65 kobo due to the central bank's intervention. As usual, for NFM, we saw a marginal gain on Friday, 0.07%, about 7 basis points drop there. Still holding that 1,600 naira psychological level from a close of 1,601 naira. But NAFEX, that's where we saw some gains there, 1.12%, 1,638 naira 65 kobo. That was the close there. So analysts expect this week it might remain, relatively stable, barring any big, economic news or other big, maybe some kind of over demand, over supply. But definitely we're still expecting some kind of stable moves there in the FX market. Well, after 1 week of deliberations, the curtain falls on the 2024 IMF World Bank annual meetings in Washington in the United States with promise to build on initiatives and suggestions shared for a better global economy. Our business editor, Ini Jomekwa, who's been covering the week-long event, captured high points in this next report. Take a listen.
The 2024 annual meetings opened on a bright note. The International Monetary Fund sees worldwide inflation cool from 6.7% in 2023 to 5.8% in 2024 and 4.3% in 2025.
We will cherish the good news, and rightly so, because we haven't had much of it lately. The big global inflation wave is in retreat. A combination of resolute monetary policy action, easing supply chain constraints, and moderating food and energy prices is guiding us back in the direction of price stability.
It was not an easy path to achieve this, and the president of the European Central Bank, Christine Lagarde, denounced the lessons.
Entirely was affected by that. But I think to have the ability and the humility to recognize that, okay, we got that wrong, and we need to reassess, and we need to re-examine what analytical tools we have, what models we use, how we are prepared to be receptive to different indicators and instruments. I think that was helpful as well.
Due to geopolitical
Unfortunately,
tensions,
the low-income countries are still struggling with high inflation and interest rates, and the risk of elevated inflation for other parts of the world is not over.
There are reasons to remain vigilant. Oil prices have been rising, in part due to geopolitical tensions, and services inflation remains stubbornly high in many countries. Further trade restrictions could also push up goods inflation. Bringing inflation back to target should remain the priority.
Ajay Banga for his thoughts on the topic.
Among other approaches of staying cautious, the World Bank Group is calling for attention to agriculture and food as engine of sustainable growth and jobs creation.
We've spoken about the potential of agribusiness. We are combining a new way of working with a new level of investment, doubling our agri-finance and agri-business commitments across the group to $9 billion annually by 2030.
Another highlight of the year's meeting is the 80th anniversary of the IMF and the World Bank Group. The commemoration comes with responsibilities and the need to adapt to new global challenges. There are requests to the form of changes from member countries.
Civil society organizations in Africa and in Nigeria in particular are demanding and requesting for a total reforms in the governance framework and relation in IMF, World Bank. This is because we believe that there's need to democratize and ensure more transparency and accountability in the IMF, World Bank, framework. It is absolutely important to understand that many countries in Africa, economy is falling down, and lack of information from both governments in countries and also from the IMF that will hold government accountable for its financial dealings with financial institutions continue to create gaps, continue to create doubt, continue to create rumors.
The global financial architecture itself is not fully reformed. Either when a country comes to the IMF for loan or if they go to the global market for loan, there are structural impediments that are there. One of those is the rating, the work of the rating agency. So African leaders are still asking that while the third share has been added, this is not enough.
It's been an intense week of conversations, and every part of the world has been represented, and their issues have been brought to the table from the countries who are debt stressed, the low-income countries, and the developed countries. The developing countries and their issues have also been discussed during the meetings in this past week. The results should be by this time next year during the annual meetings of 2025. After consultation, some of those reforms that will help both the IMF and the World Bank handle financial issues of the world more fairly will be brought to the table with the intention to build a new phase for the two institutions. And then after that, by 2026, the world will be heading to Thailand for Thailand 2026, and I'm sure they are preparing to host the world then. But for now, I'm John Mekwa signing out from Washington, D.C. at the annual meetings venue.
Yeah, so much to unpack there, and we also, had speak to some high-level delegates. One was with Iyabo Masha, the director, G24 Secretariat, who spoke about global fragmentation and geopolitical risks. Take a listen.
We took certain positions on the geopolitical tensions that are going on around the world. I think one way to look at it is that the world is now at a stage where the rules of the game that were established 80 years ago in Bretton Woods are no longer functioning for today's society. The world is more digitalized. There is freer movement of capital, lots of issues around different geopolitical blocks. So that then means that the organizations have to be reformed to make them more relevant to today's world. And that is why a lot of the discussion focused on that what are the key reforms that should happen within the Bretton Woods system to make them more relevant. I think top on the agenda for the G24 is the issue of governance reform of the two institutions. The two institutions when they were set up, the membership was dependent on the size of the economy of the countries. So at that time, of course, 80 years ago, the dominant economies are different from what they are now. And now the G24 countries control more than 60% of the global economic transactions. So we're asking for a review of the governance framework, the formula on which the quota is organized, so that when developing countries have more say in the governance structure of the institutions, then we can have the kind of policies that foster integrity. So if you look at the top 10 economies in the world, at least 4 of them are members of the G24. China, Brazil, India, they're all members of the G24. So substantively, in terms of what policies we are advocating for, apart from the governance policies, we also think that the organizations need to reform their financing model so that they can better support countries. So in the case of the World Bank, a lot of proposals are on the table to optimize its balance sheet so that it can leverage better, but it can also lend better to developing countries. There's also the issue of potentially a capital increase, because when you look at the total resource envelope, compare it to the needs of the economy of it, we're talking of roughly $1 trillion a year until 2030 to meet development and climate goals. So the World Bank has to be in a position to deploy more resources, and that will inevitably call for capital increase. And they're also, within the IMF, they're reforming the SDR, which is, if I can put it simply, the IMF money in such a way that a multilateral development bank like the Africa Development Bank can utilize this money and use it as a hybrid capital instrument that they can use to lend to other countries. So those are the kind of things going on the financing side. But then there are other issues around the vulnerabilities of the country. Many countries are either at medium or high risk of debt distress, many of the developing countries, or even those that are not at debt distress, that is, they are solvent, they have liquidity problem. So we have also made some proposals on how to address that. The ones that have liquidity problems, we're calling for the establishment of a market-based mechanism that they can use when there are unwarranted declines in their bond prices, so that they're not becoming insolvent. It's just liquidity. These are countries with sound fundamentals, countries that are running very good economic rules-based system. So that way, if we have this mechanism in place, which is already in place in the European Union, they have it in place. The US Federal Reserve has swap lines with some countries, central banks. So we want to see something like that for developing countries. Then for the ones that are at debt distress, then that's a different kind of arrangement. We want a debt resolution framework that would provide them with very comprehensive debt resolution. And that includes the timeliness, but also what kind of restructuring they get. How does the resolution going forward enables them to better handle their debt?
Welcome back. Well, so much to unpack from the IMF World Bank annual meetings with recommendations on managing global debts, growth and balancing, both to manage risk ahead. Well, joining us to analyze is Mr. Farouk Khailan, is the CEO Premium Africa Holdings. It's great to have you on the show. Good morning.
Good morning, Ladi. How are you doing? I'm
great, thank you. So first of all, let me get your key takeaways from this year's annual meeting.
It's been 80 years since the IMF was established, 1944. We haven't seen major shift in terms of significant impact, particularly on Africa. It's always been an institution that our leaders run to when there seems to be some economic distress. Some have called it a lazy approach. But in the nutshell, meeting happened. It was very important that it happened. There was a lot of stock taken. You realize that key components of this year's discussions were global economic resilience, debt management, and then climate finance. The issue of surcharge policy by the IMF was also very well, trumpeted at the meetings. There was, stakeholders, including myself, advocates who say that if these surcharge fees, which are the additional fees that is, placed on economies with high debt, if it could be remodified or, to boldly even eliminate, it will create a situation where IMF's lending is less, pro-cyclical, and then also be more supportive in economic downtimes. There were those who also came, to talk about debt relief, the usual suspects being Africa, and also it was important that conversations were aligned. If you also look at the narrative, there was also the need for some sort of, alignment between the currently important conversations around climate and then sustainable, debt mechanisms. So it was a good meeting in a nutshell. I see that the World Bank leader is speaking the language that we've always been speaking. Let's diversify our economies. Let's look at agriculture. And I think after this meeting, we'll see some shift in policy. Reforms will be very, prominent across the region. But we also need to monitor closely if indeed these call for reforms are being adhered to.
Right, and there was also talk about, most of the oil exporting countries, in sub-Saharan Africa with growth not matching, all of that oil production and exports, mostly in sub-Saharan Africa. So what kind of policies do you think, need to be put at the forefront at this point, so that we can see some kind of regional economic growth and maybe find new sources of growth for most of these countries in sub-Saharan Africa?
Yes, I think to address these complexities of uneven, economic growth, it hinges on a few, points that needs to be addressed. It's very important that we shift towards, shift away from oil dependence by investing in sectors such as agriculture. Like I earlier said, the World Bank, leader was very emphatic on that. We should look at manufacturing. Technology is here to allow us to create more, balanced growth across the region. It's also important that we look at enhancing our revenue management, implementing very transparent policies, sovereign wealth funds to manage oil revenues effectively, reducing fiscal vulnerabilities. And also it's important to ensure that equitable regional development so that we all grow together at a certain appreciable scale. Infrastructure development cannot be taken out when we're looking at, presenting solutions, investing in very critical infrastructure, including transportation, power, digital network. We should also look at how to support non-oil sectors. And we also connect remote regions to economic hubs. A lot of times when we are making these decisions, there's a disconnect between, rural areas and then the major economic hubs. There's a very important conversation that needs to be had to ensure that it's significantly connected. Governance and anti-corruption measures is also very key. We need to strengthen institutions. Africa has been, had an authority for strengthening individuals rather than institutions. We need to strengthen these institutions to be able to combat corruption, because corruption always takes us back, to ensure that oil revenue benefits reach local communities. That's regional, ensuring that reducing regional disparity and fostering inclusive development is very important. So these are some of the solutions that I think we should be able to adapt as early as possible. Because like you mentioned, there seems to be some unevenness across board in terms of how we are developing as a continent. Oil, the time for oils for our development is becoming more limited, and the transition is happening, and it's happening very fast. It's important that we sit well to be able to, not to miss out on the bounce of the ball.
And we also had the economic managers from, Nigeria and, some other African countries, and they had to have, conversations, with investors that were present at the meeting. In your view, do you think, investors are comfortable, at this time to say, you know what, all right, let's pile in some of these funds into a country, say like Nigeria, and how should Nigeria position, for that, going forward? Because we keep talking about attracting and growing our FDI, at this point.
Well, one very, very key component of attracting investment is currency stability. A couple of weeks ago, we were having a conversation, particularly about Nigeria. It would interest you to know that in the corridors that I'm operating, Nigeria comes up a lot strongly because it has numbers, it has a massive youth population. So it appeals to investors and is always on the dashboard in terms of the next, opportunity to address. But every time some sort of research is done, instability in currency, it becomes a concern. So as advisors to some of these, high net worth individuals and investors, we always say that, look, we are monitoring government to adapt exchange rate policies that reduces volatility and provide a more stable environment for foreign investment. Helping stabilizing inflation and boosting investor confidence is very critical. So I would always place it at, exchange rate stabilization is very critical, and that cannot be avoided. Every investor is looking at, this very key, elements of economies to be able to make decisions to ensure that their investments are safe. And in a case where technically you cannot rule that out, definitely there was going to be some amount of capital flight, and exchange rates play a key role in that. So I think that we should look at the exchange rate conversations keenly. I'm monitoring, I'm seeing that, yes, the central bank is making very bold decisions. It's not resonating well with the citizens, but let's look at the long-term effect of those decisions, and then I'm sure we will be able to have a conversation around the outcomes.
Right, and we get most of these recommendations. Most of the time, it's really painful, especially for the citizens. And, looking at this whole, currency stability issue, is it time to just full on peg the naira, at this point so that, everyone just feels comfortable? What do you think?
Yes. I mean, those who have said that, look, we need to be very bold. We need to grab the bull by the horn and make these decisions. I'm not going to move away too far away from that. I think it's important if it's pegged. And one thing I also want to appreciate that we should be very inventive. We should be bold. At this point, some people have raised their hands in despair, lost, and has been thrown in. Why don't we also adapt certain bold policies? It might not be popular, but trust me, in the culture of being proactive, the sense of urgency. If you look at what is happening, I never stop talking about Middle East. It's an economy strategy that goes to say, let's do this, let's try this. We've got nothing to lose. Worst case scenario, we go back to what we already know, or even in the process of being inventive, we're going to learn. So I'm not going to rule that out at all. But then it needs to come with a lot of education, a lot of collective stakeholder engagement. That decisions should be made across board. Every individual or institution that is directly involved in currency conversations, currency management, fiscal policy, monetary policy, should be involved to make that decision. And I'm sure that the outcome will be inspiring. If not, we're going to learn from it and go back to the drawing board and make certain decisions again.
This shift towards, green energy, and definitely it will impact African oil producers. Is the best time yesterday, for these countries to start fully, exploring we've been talking about the great transition, at this point. Should they start channeling all of those funds into that now?
It is, this is what we've always been talking about, that sense of urgency of Africa. We sat down for transition to hit us. We had so much oil, we had to make good use of it, use this oil to develop our economies. We were still pacing, we weren't too serious about it. It was business as usual. Look at what has happened to the Middle East. Middle East has used oil to develop its economy significantly and even moved away from oil reliance long time ago, moved into tourism, moved into agriculture, moved into other sectors of the economy, and are already miles ahead of us. Now transition is here. We didn't maximize on what oil was supposed to do for us. And even when it comes to the transition, same culture of, snail pacing, business as usual. Documents are sitting at policy framers' office, it's not leaving. Somebody has to sign, he has traveled to a funeral. It's a major concern. Now the transition is here. We don't also want to miss out on this opportunity. Whether we like it or not, the transition is happening. Let's see some investment in solar. Let's go hard in solar, wind energy, hydropower could offset revenue loss from oil, whilst leveraging Africa's rich natural resources. We have the natural resource when it comes to renewable energy. Impeccable amounts of it. But like I said, the earlier we make good use of it, the better for us.
Right.
That sense of urgency should be now. It should be now, Ladi. We cannot wait anymore.
Right.
Natural gas as a transition fuel should also be used to, to bridge the gap. Because as the transition is happening, a lot of African countries have significant gas reserves that can, can serve as a bridge fuel during the energy transition. Using that to support both regional energy demand and export opportunities as well.
All right, we already see Nigeria relying heavily on gas for this transition process. But it's always great having your perspective. Thank you so much for coming on, Mr. Farouk Kailan, CEO, Premium Africa Holdings. Thank you so much.
Thank you. Thank you very much, Ladi. Always a pleasure.
All right, let's get a quick check on how the markets played out last week. 1.41%, that's for the all-share index. Closing the week, 99,448 points. The markets are open now. We'll see if this bullish trend continues. We'll see the market cap, a massive 60 trillion. 60 trillion, that's for the market cap. Let's look at activity for the week. We see volumes up about 2.14 billion units. That was traded last week. You see investor appetite was really strong last week, 85 billion. That was the value deals, 41,217, all in the green. Let's look at the top sectors now. See banking led the pack last week, 7.86%. Consumer goods was the only one in the red, 0.84% down. Then we also see insurance, that's also in financial services, also up by 4.04%. Oil and gas, 3.95%. So markets are open now. We'll see if investors, continue in this last trading week of October from the bullish sentiment and maybe across above the 100,000 for the all-share index. Markets are open now. We'll give you an update at 1 p.m. on how trading is going locally and most of the global markets we track. I'm Ladi Williams. That's it from me on Business Morning. I hand things back over to the Sunrise Daily team.